Welcome back, traders and investors. Joel Elconin, Dennis Dick, Joe Saluzzi, and now Larry TABB. This is Benzinga's pre-market prep, brought to you by Charles Schwab, talking about high-frequency trading. Larry, how you doing today?
Doing great. How are you guys?
Good. Tell us about the TABB Forum.
Well, TABB Group is a research firm. We focus on writing research on financial markets, really mostly about infrastructure. The forum is really just an open forum for the community. We post interesting articles that folks in the community write. We do some videos. People comment. It's a really good place for people to understand market structure and understand what people are thinking about.
Larry, you get a lot of different opinions there on the TABB forum. I'm a big fan. I think you guys are doing great stuff over there at TABB. What are the main concerns that are coming from your contributors there? What do you think the main concerns are with the market structure?
The main concern is I think a couple-fold. Mostly it's from the institutional side of the market, that the regulations and the SEC has kind of looked at the market from a protecting the individual investor perspective, and we can argue about that a little bit. But everything has kind of, all of the larger trades are now broken into very smaller pieces and basically sprayed around the marketplace. And for individuals, that tends to be better because they can get filled pretty quickly on small orders. The problem is if you're a large mutual fund and you're trying to execute a large block of stock, it becomes very hard because these 20, 30, 50, 100,000 share orders have to be broken up into 100 share pieces. And as these orders get executed around the marketplace, they leak, and people can figure out what's going on, and they can be taken advantage of if it's not done carefully.
We've had Joe Saluzzi on here for about 20 minutes here now, and he was saying just exactly what you're saying. He's on the other side of this. He's trying to work orders and trying not to get them to leak. What is your suggestion here to, Joe? Like, what is the best way to, not get these orders to leak?
It's pretty challenging. There are 11 exchanges. There are 42, 43 dark pools, and trying to find the other side of the order can be really hard. Mostly it's about using the right algorithms. Well, first of all, if you can find a block, if you can find a large block of stock and trade that, most institutional investors will want to do that. The second issue is try and use sophisticated tools that help hide your orders and trade them efficiently. The problem is that it's really difficult to determine, especially when orders are moving at microsecond levels or speeds. It's really hard to determine whether they're being routed efficiently. And actually, we just started to create a product around that that we're calling Clarity. But it's not an easy solution. It's not a one size fits all. The one thing you shouldn't be doing is going to a lit venue and putting in a very large order for thousands of shares. That becomes very problematic. But the orders generally have to be split into smaller pieces. They have to be managed very carefully. They generally using algos to move them around the market and try to find the other side with as little leakage as possible.
Joe, what's your thoughts here? You don't want to come into the market and show your big size, but like Larry says, but how exactly do you not leak your orders? And I don't want to get into your secret sauce here, but right. Do you do what he's saying, breaking them all up into smaller orders? Do you agree with Larry here?
Well, it's a dance. It is a constant dance throughout the day that you do. And unfortunately, Larry's right. You can't go out there and show real size. They're going to just run ahead of you. But you are moving around. You're using your technology and using your smarts, and I do think it is paying attention is really what we do, and you got to watch the tape. I mean, a lot of guys don't have the capacity anymore. They've stripped down their trading desks to almost nothing. But if you're watching the tape and you're looking where the prints are going up and you're talking to your clients, you can strategize more. And I think Larry just mentioned the product that they're coming out with Clarity, which I think is a great idea. And I'd like to ask him, Larry, what was the stimulus for the product? Was it the buy side saying, hey, we're just so frustrated with the sell side and these smart order routers in the dark pools. We don't know where our flow is going anymore. We really want to analyze this better so we can get a better grip on it, because I think if that's the case, then they'll decide themselves and say, you know what, I've got a venue where there's some adverse selection. Kick these guys out. Kick those guys out, and then maybe you start to get a better, feel for your flow, and you can get a better execution. Was that it, Larry? And also, what kind of response are you getting to the product?
Well, thanks, sir. We've gotten great response. Actually, within a week, we've got meetings and calls scheduled with 20 top mutual fund, large buy-side traders. So it's gotten tremendous reception. The genesis for it was really we started looking at writing on the TABB Group side, started writing about venue analysis good 2 years ago, and people starting to complain that the market structure is getting too difficult to manage, that I'm getting taken advantage of here and there. But we really didn't have the facility to really analyze the data. Earlier this year, I ran into a guy that I've known for a number of years. He's in between roles, and he had the capabilities with a couple of his buddies to come in and really actually do it. And we talked about, the problem is that it's very difficult to do this when you're a broker, because the other brokers, what you really need to do is you need to get the routing data. And the routing data, basically, I carve off 100 shares and I send it to these dark pools and I send it to these exchanges. And by the time it gets executed, it might have gone to, 8, 10, 15 different venues before it got filled. And so what we're trying to do is manage what happens at each of those stops and what was the impact, what was the leakage, and giving one broker giving that information to another is really challenging, because they don't want, because that's your secret sauce, how their routers and how their algorithms work. So we were kind of a natural place for these guys to come and try to build that out, and so we've been following it. We found the opportunity. We seem to be a really good place, independent and trusted, to do it, and that's why we kind of got involved. And from a buy-side perspective, you've got books coming out and saying that the market is rigged. You've got the New York Attorney General complaining that there are things going on in dark pools that people don't understand. And the buy-side trader, even though they look at transaction cost analysis, PCA only looks at the fills. It doesn't look at the routes. So it's really hard to determine if the algos that these guys are using are leaking information. And we've been talking to buy-side guys, and it becomes harder for them to participate. If they want to participate and be, 10, 15% of the market, it's getting harder and harder, and the larger orders are taking, instead of 1 day, they're taking 2 days to get filled, and the market risk in doing that is really, really challenging. It's not very good for them. So everybody really wants to try to understand how to better engage with the market.
Larry,
that's why the plumbing is so important. What we talking about before, the market structure plumbing, and how complex and overly complex it's gotten, to the point where Larry's using a massive computer analysis to figure out exactly where something's being routed, because we need to know now, because of these conflicts of interest that are out there, right? The rebates for going from one pool to another, or maybe an incentive for a dark pool to send an order to an electronic liquidity provider first before it goes out there. These conflicts are the ones that we're talking about when we say broken markets, and when Michael's talking about rigged. Those are the ones we need to address here, and that's where the regulatory action has to come in. Let's simplify this, get rid of this noise, and then maybe we don't have to overanalyze it to that point. Maybe we don't get broken up into 50, 60, all these odd lots that are going through. I'm sure you see them nowadays. It's insane what's going on. I'm trying to trade a block of stock, like Larry said. I'd love to do the block, but instead I got to deal with the noise. And by the way, one of the answers to your question before, one thing you can do, which we recommend to everyone, put a minimum fill size. If you're in a dark pool and you're sitting there without a minimum fill size, you're going to get just pinged all day. Put 500, 1,000 share minimum if you're an institution.
And what Joe's talking about, they're pinged all day, is they actually have the order sniffer algorithms that will send small orders into the dock into the dark for 1 share or 2 shares or 3 shares, not 300, like literally 3 shares, trying to find out where that hidden liquidity is. And then they know they can lean in that area, or they know that, there's an order there that they can hit if they need to hit it. So they're trying to basically map out the liquidity of where it all is. Larry, how do we get these predatory guys out of the market? Like, if you could can't we just simplify everything? Can't we just like go back to, bringing buyers and sellers together? Like, isn't that the point of exchanges? Now we have, like you said, 11 different exchanges and 50 dark pools, and all kinds of internalizers. You have it's so complicated, so fragmented. How do we just simplify everything?
I am not as negative as you guys. Yes, there are some folks doing some predatory stuff, and they need to be stamped out. But the other issue is that the commission structure has gotten to the point that especially on low touch trades, some of the brokers are charging 60 cents per 100 shares, 55 cents for 100 shares, and if the exchange is getting 30 cents per 100 shares, it doesn't leave a whole lot of room for the broker. So, Clarity isn't just a tool to basically get the brokers to go, trade in expensive venues. It's really a mechanism to balance. The thing that these guys are trying to balance is the execution price against the fee for execution, against the opportunity cost. So how long do I have to take? And so what'll hopefully come out of this is a better discussion as to how to tighten up the process. And if they're getting picked off, let's, as Joe says, increase the minimum share size in the dark pools. Let's figure out where the dark pools are leaking information. Let's try to tighten it up, because to a certain extent, if we go going backwards, one of the bad things, certainly one of the bad things about the market structure is that with all these different places, yes, information is leaked and you can get gamed. On the other side, the commissions are lower than they've ever been, and so you're trading price versus time versus cost, and it's hard just to say, well, let's go back to a two-market solution, and because to a certain extent, you're probably going to wind up with a more expensive solution, and so the issue becomes more about trying to understand where your costs are and working with your partners to eliminate those costs where you don't want to, and try to figure out what do you really want to pay for and how do you want to get executed.
Larry, we just got about a minute left here with you, but I just want to flip it just for a quick question I want to ask you. What about off-exchange trading? We're watching this rise in off-exchange trading. It was 18 or 20% 4 or 5 years ago. Now it's approaching 40%. At what point, at what level would this growth in off-exchange trading actually start to impair public price discovery? Are we approaching that level here yet? And is this a concern to you?
Oh, geez, man. I wish I knew the
big
answer
question.
to that. Yeah, it concerns me a lot. I've been writing about that, and it's not just the overall. I think our number now is somewhere around 37% off exchange trading. I would like to see it back in the 20s, maybe in the low 30s. But that's actually not the issue. The issue actually is when you break down dark liquidity, you need to look at it in tiers and buckets. So, going from less liquid to more liquid, and going from cheaper stocks to more expensive stocks. So your penny stock to your Googles or whatever, or your Berkshire Hathaways. And if you break that into the little buckets as to less liquid and low price to more liquid and higher price, you wind up with a number of those boxes actually with more than 50% of the liquidity trading in the dark. And those things tend to be in the less liquid range, the things that, the stocks that don't trade very much, as well as the low price stocks. Now, the things that don't trade, they're going to funnel into dark pools because nobody wants to show their hand. But it's the low price stocks that are trading in the dark that are really about cost structure of the exchanges and access fees. And so I think if we can lower the access fees on the low price stocks, that would do a lot to kind of push things back into the marketplace.
We've had Larry TABB on here with Joe Saluzzi, Larry TABB of the TABB Forum, giving his take on high-frequency trading. Larry, thanks for coming on, and please join us again on Benzinga's Pre-Market Prep, brought to you by Charles Schwab. Going to take a quick break and bring on Eric Huntzader.